When the Coalition unveiled its $34 billion tax policy on Monday, the ALP said it would take all the time it needed to crunch the numbers before releasing its own version. Under pressure to get its policy into the public arena before the Sunday night leaders' debate, Kevin Rudd and would-be Treasurer Wayne Swan delivered on Friday afternoon. $3 billion separates the two policies. Labor would divert the difference into education tax rebates, deferring income tax benefits for high-income earners. To discuss the economic implications of the policies, I'm joined in the studio by BT Chief Economist Dr Chris Caton and Chief Investment Strategist at Russell, Andrew Pease. Gentlemen, thank you both for joining me this morning. Now, Chris, if I could ask you first, whichever party comes in, they're both offering very generous, really, tax cuts, and $31 billion at least is what we know we're going to spend. Effectively, every income earner gets something. Now, if these tax cuts come out of the surplus, what impact is that going to have, particularly on inflation?
Well, it may not have very much direct effect on inflation, but importantly, we've got an economy right now that is fully utilised. It's stretched to capacity, and anything that adds to demand, be it a tax cut or more spending by consumers or whatever, anything that adds to demand does run the risk of contributing to future inflation pressures, and hence runs the risk at the margin of leaving us with higher interest rates than we otherwise would have.
Andrew, would you agree with that?
I think that's the case. I think that if you do see extra demand, it does increase pressures, but I think Chris is right in saying that it really is at the margin. I think given the strength of the resources boom, given the strength of the underlying economy and the tightness of the labour market, it's more than likely over the next 12 months that interest rates are headed higher in Australia here, and that would be regardless of the magnitude of these tax cuts.
Oh, okay, well that's interesting because of course a lot of people said this will, well some economists have said this will definitely feed into inflation and therefore definitely into interest rate rises. You're saying we're going to get them anyway?
I think so, and I really think the debate about this fiscal policy looseness is about, when you look at the numbers, there's projecting 1% of GDP fiscal surpluses going forward. That's not really stimulatory. What people are arguing is that the government should have allowed the surplus to rise even further to counteract the strength of the economy, and that's the debate we should be having as to whether the government should have allowed the surplus to get even larger.
Okay, would you agree with that?
Let me say this, it's just odd to be loosening fiscal policy, and that is what we're doing when we basically give back these rivers of gold every year in a tax cut while you're tightening monetary policy. But it's very, very difficult politically to just sit there and let the surplus get bigger and bigger and bigger. So yeah, we should be having that debate, but there's a division here, I think, between what's good politics and what's good economics.
So are you saying this is a good old-fashioned election bribe and maybe not as sound economically as we're being told it is?
I guess I would say this, that the political case for this tax cut is stronger than the economic case.
Okay. How long in reality before the cuts are effectively, I guess, wiped out by rising interest rates?
Well, that depends on the individual, essentially, how big their mortgage is. But you know, for a lot of people, 2 interest rate rises would would more than wipe out the effect of the cut. So it's a delicate balancing game.
Absolutely. Now, Chris, lifting the income level, which is another thing both policies are doing, from $30,000 to $37,000 before you pay 30% tax. Will that result in more people getting into work, or at least part-time work, and is that a good thing?
Well, the Treasury has done some modelling, or looked at some modelling on this, and they say yes, this tax cut, to the total effects of it, will add another 65,000 people eventually to the workforce. That's not small change, but it's not huge either.
Because it probably will be more part-time work, won't it?
Yeah, that's probably correct, yes. But importantly, the tax cuts that are designed to push up supply as well as demand, they always push up demand more than supply.
Okay, well now speaking of interest rates as we are, and before we get back to the tax policy, I want to ask you both about, people are talking about an interest rate rise before the election, Andrew. Next month on the Reserve Bank is meeting, I believe, on Melbourne Cup Day. Do you expect one?
I think people are getting a little bit carried away with talking about a pre-election rate rise. It's really going to come down to this week's CPI number, and the only way the bank's going to go pre the election is if the inflation numbers are so compellingly high that it looks political not to do anything at all. I think with having cut already in August, with the Fed having cut by 50 basis points, with the exchange rate going through 90 cents, and with a lot of uncertainty about the US economic outlook over the next 12 months, I think there's a strong case for the Reserve Bank at least waiting until they get the next set of CPI numbers after this one to get a real measure on the strength of those inflation pressures.
Chris, would you agree with that, or do you reckon they'll go for it?
Broadly, yes. Andrew said it comes down to the CPI inflation figure, and it does, and in particular the underlying inflation figure. And it's a bit odd that these things can turn on a 10th, but I reckon the Reserve Bank raises if underlying inflation is 0.9 or higher.
Okay, so if on Wednesday underlying inflation is 0.9 or higher, you think the Reserve Bank will raise rates?
Well, it depends a little bit on the flow-on effects from the Friday night weakness in the US share market, but almost certainly. If it's 0.7 or lower, I think they pass, and that gives them a real decision, if you like, if it's 0.8. But that line in the sand may be somewhere else, but that would be my guess.
If we have another rate rise before the election, is that the death knell for the coalition government? That'll be the 6th, I think, since the last election.
Yeah. It's not going to help them, obviously, but I don't know if it'll make the difference between win or lose.
Okay. Now, obviously the US is in a little bit of trouble. Andrew, where do you think that really is heading? Are we heading for a recession in the US?
Well, there are two stories there. There's what's happening in the markets and what's happening in the economy. And obviously the debate on the economy is going to be very much on, is the US heading to recession? There is a strong sense that after we're all very pessimistic in the middle of August in the midst of the subprime crisis, we've switched far too quickly to over-optimism and said that the US housing sector isn't a problem.
We're so fickle, aren't we?
Those earning reports on Friday night, I think they were a good reminder that there are some pretty bad things, and the housing market there is arguably in worse shape than it's ever been. But I don't think we'll have a recession, but I do think we'll have a debate about a recession. The US corporate sector is in fantastic shape. Profitability has never been stronger, and as long as your average American is not concerned about losing their job, I think we're going to see a slowdown in the US economy, maybe a protracted one, but I think a recession probably won't happen.
Andrew, something I want to ask you about with back to the tax policies. Now, Labor has deferred any tax benefit for those earning over $180,000. Now, because they're treating that differently to the coalition, would they each have different implications for the market? I mean, for instance, to people on that sort of money, do they actually invest the tax benefit they get, or do they just blow it on bigger TVs and faster cars like everyone else?
Well, I think we all do that, but I think
some of us.
I think it's pretty marginal. That type of policy, I think. And I think the other debate that we need to think about with what's happening with these tax cuts too is at the margin too, they do reduce wage pressure as well. But, you know, there's a lot of things in the mix, and I don't think you can make very simple conclusions from the adjustments.
Do you think, Chris, the market might have been disappointed that there wasn't real reform in this, there wasn't corporate tax reform, and even though superannuation has been so generous over the last little while, that perhaps there weren't more moves in the superannuation area?
I think business was probably disappointed there wasn't a reduction in corporate taxes, and I think the case, given that we cut personal taxes every year now, I think the case for a corporate tax cut out at some stage is getting stronger.
Yeah. But corporates don't vote, do they?
That's right, they don't. That's right.
Not as a mass.
Superannuation reform, I mean, you made the point, we've made it so generous. I guess the only thing that would make more sense, essentially, is to cut the tax on the money on the way in, but it's so generous now that it's difficult to see we need much more reform there.
All right, we do want to wrap it up, but Andrew, I just want to ask you about this view that the theory that international investors have put a stability premium already on the Australian market.
Yeah, no, it's an interesting point, and you know, ours is the economy that missed the Asian crisis, that missed the tech-wrecked recession, so it's quite reasonable to think that foreigners might think that our market's more stable. They shouldn't attach a premium to that. And our equity market is on depending on how you measure it, trading at either a 10 or 20% premium to global developed markets. But there's also a very strong point that Australia is very unusual. We have a lot of money every month pouring into our market from superannuation, and we've got the Future Fund investing their $50 billion now. So, you know, it's a bit of both each way, and I tend to suspect that a lot of it is those forced flows from superannuation that really is propping up our market.
Okay, gentlemen, thank you very much for both joining us. Chris Caton and Andrew Pease, thank you.